Hello, David Shapiro here. I am going to talk to you about how to do a return on equity analysis. This is really useful at the end of the year if you're just doing a review of your properties, maybe trying to determine which one is underperforming the rest if you want to sell them. Maybe you get an offer, like this is the case for me. I received an unsolicited offer, so I'm going to go through and figure out, does it make sense to sell this property? So let's dive right in. So I've got the current market value. This is a spreadsheet I built. You don't necessarily need one this fancy. You basically take what you're getting offered for sale, subtracting all the costs and the loan balance. And so for me, you can also just kind of see for fun here, the gross equity percentage is 41%. So meaning I have 156K in equity on a $395,000 property. So if we look at this formula, that's how it should be doing the math. Okay. I also want to take into account taxes because what I'm really trying to figure out is how much money is going to land in my bank account and what kind of return am I getting if I leave that in there. So in this case, I'm assuming a 15% capital gains tax rate, which would leave me, based on the cost basis that I've calculated, a net after taxes about $140,000. So one quick note on cost basis is you take the purchase price of the property and you also have to calculate in how much of that was. Well, basically, you look at your tax returns if it's a rental and you see how much you were depreciating. So I know that roughly $250,000 of this was structure divided by 27 and a half years times 3 years that I've owned the property. So that gives me what my cost basis is. And then, so there's 140,000. So now what is my return? So right now, let's see if this is right. So annual gross cash flow. So annual profit, it's saying about 22,000. So what my cash on cash return on equity should be this number divided by that. So I'm getting roughly a 15% cash on cash return. Now this is some formulas to try to figure it out. And this is actually using those formulas. But what I'm going to do is I'm going to go look at my P&L and I'm going to pull that number and put it in right here. Profit is 25,000 after I make some adjustments. So when we look at that, and I'm just going to ignore some of these numbers. Really, I'm just focused on this number right here, my cash on cash return on equity, 17.82%. So now a new buyer would actually get a higher percent return because they're probably coming in with a newer loan. They're probably going to put down 20%, 25%. So they could actually have a better return. So that's why it's important to calculate this differently. And then here I'm showing, okay, well, what if I were to hold it another 5 years? What happens to this property at that point? And it looks like it's still like a 14% IRR moving forward. So this property, I'm not assuming zero appreciation, some rent growth. Maybe that's unrealistic. Maybe it should appreciate. And so if we look over here, the 156,955, let's see where that's pulling from. B15. So that's the equity it's saying that it's return on, which is a little bit different because I'm here using the after tax. The other thing you could do is say, well, what if I were able to 1031 exchange this and essentially pay zero taxes? Well, this number is supposed to change. Why doesn't it change? Hang on, let me investigate. Okay, I found the culprit. I was using 15% in here in this formula instead of using the cell. And it's getting messed up. Okay, so let's multiply that times 15%. That number should stay the same. But now when I say, okay, what if we do this? Great, 156,955. So now my return on equity is 16%. So then I have to determine, does it make sense? So the other thing to look at is, okay, well, out of this annual profit, there's time that's going into managing this property. So my team probably spends, my guess is about 15 hours a year. We don't really track it, so this is just a total guess. But this is something I think you should take into account is your time, and you might have a better idea. So let's just say their time is worth 100 an hour, at a minimum. And then my time, let's just say I'm spending another 10 hours times 500 an hour. So now if we start removing these numbers from here, and this seems low for my team, it must be more than 15 hours. Let's say it's 25. Okay, so then that's now drops us down to 17.5. So if I were to say this is 17.5 So now my return is 11.15%, right? And then there's other things to take into account. This property isn't the easiest to manage, so there's some value in selling this one and 1031ing it into a different property that's a little bit closer to home, easier to manage. There is something to be said about even just 11%, pretty conservative cash on cash return. So this certainly isn't an easy decision. In the past, these things have gotten so, where it's like 60% equity and the cash flow is not great. And so this is like a 6-7% return on equity. And in that case, it really, for me, is a no-brainer. But at this stage, this one's really close, so I'm gonna have to do some further thinking on it before I make a decision. But that's roughly how you do the return on equity calculation. I think it's important to know the difference between this and return on investment or other calculations that you could do when you're deciding whether or not to dispossess a property. If you like this, please go ahead and like the video, subscribe, and don't hesitate to comment with questions below.